the screen.
Okay, now we shall go ahead and take an example on accounting for reverse acquisition. Now let's go ahead and take on this example and understand what is the meaning of reverse acquisition, okay, and how should you account for it. Applying the guidance in appendix B19 to 27 IND AS 103 on business combinations. Yes, sir.
On 31st December 20X1, entity A issues 2.5 shares in exchange for each ordinary share of entity B.
It's given that I bought A Limited. Let's say you are the shareholders of B. I bought your company. I'm going to issue 2.5 shares in my company for every one share you guys are holding in B Limited. Yes, sir.
All of entity B's shareholders exchange their shares in entity B.
That means what? No non-controlling interest. All the shareholders accepted the 2.5 shares in A Limited for every one share in that they are holding in B Limited. Yes, sir.
Therefore, entity A issues 150 ordinary shares.
So how's the 150? Just see the balance sheet. What is the share capital of B Limited? It is 600 rupees, right? And face value, rupees 10 per share. That means there are 60 shares in B. That means you guys are holding to Subhash, Pavitra, Sneha, Venkat. You guys are holding 60 shares in B. And I am offering 2.5 shares in my company A Limited for every one share, right? What is 60 into 2.5? I am offering 150 shares to you people, and I'm going to buy the 60 shares. Now, for me, in my books, separate financials, it will be investment in B, right? And I'm going to issue 150 shares to you people in my company. 150 shares are issued. Now, tell me, Subhash, what is the share capital of A Limited?
300.
And have you done the number of shares?
100.
There are 100 shares. You might wonder, so what's the 3 rupees face value? Doesn't matter, don't bother. Okay. So it is 100 shares. Now tell me, what will be the total number of shares in my company after acquisition? 100 plus another 150 shares issued. Don't add the amounts, Sneha. It is 100 shares plus another 150 shares issued to you people, right? Now tell me, what is the total number of shares in A Limited now?
250.
250. Of these 250 shares, how many shares are held by you people?
150.
So what is 150 upon 250 into 100? In fact, now you control 60% of the group. Yes or no?
Yeah. Reverse.
In fact, you will also control your previous company B Limited through A, right?
Yeah, yeah.
You get it? Now you control the group as such.
Yes, sir.
Got it?
Yes, sir.
You not only control A, also you'll be controlling your own company B Limited through A. So A is invested in B, right? Got it?
Yes, sir.
And I tried to hunt you down. I got hunted. The hunter becomes the hunted. And here what happens? Who's A? In this case, I can say A is what? A is a legal parent. Legally, I am the parent entity because I am holding shares in you, right? Legal parent. Because the point is, in A Limited books, it will be investment in B. A legal parent, no doubt. And what is B? The legal subsidiary. But for accounting purpose, we always, we learn on popular maxim in our foundation days. What is that?
Substance.
Exactly, substance over form. Just, that's such a small statement.
Yeah.
That's such a great impact. So, going by the substance, in substance, A is the legal parent, but an acquiree for accounting purpose. You get it?
Yeah.
Whereas B is a legal subsidiary, but what? An accounting acquirer. And in the guidance, they keep on using these words. A, legal parent, accounting acquiree, and B limited, the legal subsidiary, but accounting acquirer. Sir, what is happening, sir? No, it's easy. I'll tell you. Therefore, for the purpose of accounting, A Limited's assets and liabilities will be fair valued. But one problem is there. See, the consideration I paid you people, right? The 150 shares are issued at fair value per share. Should be the consideration. But for accounting purpose, because you are the accounting acquirer, I am supposed to find how much consideration you would have paid me had you acquired my company. Okay, you had to issue equity shares to my shareholders, the holders of 100 shares, right? What would have been the consideration?
Oh.
No, such a clumsy accounting.
Yeah.
But you have to follow. And this accounting is first suggested by the US GAAP. You have to do this way. That's it. Now I'll tell you, when a company goes through a reverse acquisition, there are cases where there is a shell company, there is something called a special purpose acquisition company, SPAC. I remember long back we also read Subhash about SPAC.
Yeah, yeah.
I'll explain that, don't bother. Don't bother, I will explain why companies go through something called the reverse acquisition. Okay. Now let us go ahead and read the question further, sir. Where are
The
you?
fair value.
150 shares. Over there, 150.
Yeah,
from
150
there.
shares in exchange for all 60 ordinary shares of entity B.
Very good.
The fair value of each ordinary share of entity B at 31st December 20x1 is 40 rupees.
40 rupees what? Fair value per share of your company, B Limited.
The quoted market price of equity A's ordinary shares at that date is 16 rupees.
Why is that? Why am I giving quoted price of 40? A may be a listed company. This happens generally. In reverse acquisition, A will be a listed entity, public company, a listed entity in a stock exchange, whereas B will be what?
Private.
A private operating company. Is that fine?
Yes, sir.
Now these 150 shares given to you people now are what? Are publicly traded, yes or no?
Yes.
Now you got listed shares.
Yes.
Now what happened to 60 shares? Now held by A in B. That doesn't matter right now. You got 150. Earlier you had 60 shares which are not tradable in the market, right?
Yeah, yeah.
Unlisted entity. But you got 150 shares in A which are trading in the market. You know how B Limited got itself listed without going through the IPO headache. Anyway, don't bother. I'll talk about that extensively later. But right now, just focus on this. Okay, on the numbers. Yes, sir.
The fair values of entities A's identifiable assets.
Now, what
and
is my
liabilities.
quoted price, sir? 16, is it?
16.
Now, you got how I got the 2.5 exchange ratio?
16 by
My shares are trading at 16, and your shares are trading at
40.
40. Not trading, at least valued at 40. Therefore, how many shares in my company will equal one share of yours? Divide 40 by 16. How much? Exactly. There is another way to find 2.5. I'll tell you, a roundabout manner. Now, how many shares you guys are holding? 60 shares.
Yes, sir.
And your shares are worth how much? 40
40.
rupees each.
Yes, sir.
What is 60 into 40?
2466.
I am supposed to pay at least rupees 2,400 either in cash or in shares. But I decide to give shares in my company. Now, what is 2,400 rupees divided by 16 rupees per share? I got to issue 150 shares to you people. Now, what is 150 by 60? 2.5 is to 1, right? Yes or no? Yes. Understood?
Yes, sir.
But don't try in all the sums. Okay. That is the reason you must have got this 2.5 is to 1. Okay. Next.
The fair value of entity A's identifiable assets and liabilities at 31st December 20x1 are the same as their carrying amounts, except that the fair value of entity A's non-current assets at 31st December 20x1 is 1500.
People wonder, so why is given, see, B is the acquiree. That is legally, yes or no? They should have given the fair value B, right? But what are they given?
A.
They given the fair value of A. Because for accounting purpose, A is a acquiree.
Quite.
You'll get used to, don't bother.
Yeah.
First time when I taught this sum, I was struggling. A, the legal parent, or they can say legal acquirer, they'll use that also, the word. Or accounting acquiree. I go slow. A limited, legal parent, or you can say legal acquirer, but accounting acquiree. What about B limited? Legal subsidiary, or legal acquiree, but accounting acquirer. Got it?
Yes, sir.
Yes or no?
Take 4.
Next.
The balance sheets of A and B immediately before the business combination are, we have given the current assets.
Yeah, given the
non-current
balance
assets,
sheet.
Yeah.
Actually, should have been non-current asset first. Current assets, non-current assets,
Total,
and then total,
current liabilities, non-current liabilities.
and
total.
then comes equity, share capital and other equity or retained earnings. Okay, sir. Then
Assume that entity B's earnings for the annual period ended 31st March 20x1 were 600.
the earnings, only if they ask for earnings per share, it is required. Otherwise, not required. Next.
And that the consolidated earnings for the annual period ended 31st March 20x2 were 800.
And these numbers are not relevant in this example. Next.
Assume also that there was no change in the number of ordinary shares issued by entity B.
Again, not relevant. Okay. Next.
So, copy paste
That's what. Then.
calculate the fair value of the consideration transferred, measure goodwill, and prepare consolidated balance sheet as on 31st December 20x1.
Okay. You know what happens? Majority will write 150 shares issued by A Limited at rupees 16 per share. 2,400 is a consideration. You're wrong. Remember, because B is the accounting acquirer, I am supposed to calculate, had B acquired A, what would have been the consideration paid by B to the shareholders of A?
100 into 60.
Exactly, that's a shortcut. You can do that. So, how many shares are outstanding in A Limited? 100. Yes or no?
Yes, sir.
100 shares. And what is a price per share? 16. What is 100 into 16? You are supposed to pay my shareholders at least 1,600, and your shares are worth how much? 40 rupees each. So what is 1,600 by 40 rupee per share? You got to issue at least 40 shares in my company to my company shareholders. You got to issue 40 shares in B to my shareholders. I'll go slow, okay? Guys,
Yes, sir.
take a calculator, take your pen, take a paper, and also take your brain along with it, okay? Don't shut off. Listen. We know there are 100 shares in A Limited, my company, yes or no?
Yes, sir.
And my shares are worth rupees 16 each. In case you want to make a proposal to acquire my company, okay, it doesn't matter, indecent. So in case you want to buy my company, so what is 100 into 16?
16.
You got to pay at least rupees 1,600 to my shareholders, yes or no?
Yes, sir.
Because you're going to issue shares in your company which are what? Valued at 40 rupees each. What is 1,600 by 40? Exactly, you got to allot 40 shares to me in your company. Got it?
Yes, sir.
Now you check this. How many shares you guys are holding? 60? Yes? And how many shares you would have issued to my shareholders?
40.
40? Totally how many shares?
100.
Okay, don't compare this 100 with that 100, okay? 100. Now tell me out of this 100, how many shares you're holding?
60.
You're holding 60. What is 60 by 100?
60.
60%. Same as 150 by 250.
Mm.
Yes or no?
Yeah.
Therefore, there is another way to find these 40 shares. What are you going to do? Understand this way.
150.
Now, how many shares you guys are holding in your company? 60. If this should represent how much? 60%, right? Because in the combined entity, you want to have 60% stake.
Yeah.
And my shareholders only 40%. Even though it is 150 by 250, it doesn't matter. 60%, right?
Yeah.
So had you bought my company and you want to maintain the same percentage control, then find how many shares you would have issued. Take a calculator. The 60 you're holding represents what? 60%.
Yeah.
What is for 100%? Should have been 100 shares, right? That means the total number of shares in your company, had you acquired my company, would have been 100 shares.
Yeah.
Minus 60 you're holding. What is the balance? You had to issue how many shares? 40 shares to my shareholders. Worth rupees how much? 40 rupees each. How much? 1,600. There are two ways of finding out. Very simple. You guys are holding 60 shares in your company, Subhash.
Yeah.
Should represent what? They should represent 60% holding in the combined entity. But that's what, no? 150 by 250.
Yeah.
60%. So if this 60 represents 60%, what is for 100%? Or what is for 40%? That means you got to issue 40 shares to my shareholders, so that in the combined entity, even if B acquires A, you still have a 60% stake in the combined entity. Understood?
Yeah.
Doesn't matter whether A acquired B or B acquired A, you should hold 60% stake. Understood? What about the balance 40% controlled by my shareholders? Got it?
Yes.
So you'll issue 40 shares to me, to my shareholders, worth rupees 40 each. Because that's the price of one share on your company, fair value. So 1,600. Is that fine? Got it?
Yes, sir.
Yes?
Yes, sir.
Now this is the toughest part here. Once you get the consideration 1,600, it's no brainer for you to find the goodwill. What you should do? Calculate the fair value of the identifiable net assets of which company? Of A Limited, and compare that with the 1,600 purchase consideration had you acquired my company. The difference what is?
Goodwill.
Goodwill. Again from bargain purchase. Now shall we go through the first three steps? First we got to identify it's a reverse acquisition. What is step 2? Calculate the purchase consideration. And number 3, let's calculate goodwill. And then we'll take on the balance sheet later. Is that fine?
Yes, sir.
Yes, sir. And remember, all these guidance are there in Appendix B 19 to 27, IND AS 103, and we will go through that. Is that fine? Yes, sir.
So let's see, Appendix B 19 to 27.
19 to 27, sir. 19 through 27.
I'll read the solutions. Identifying the acquirer. As a result of entity A issuing 150 ordinary shares, entity B's shareholders own 60% of the issued shares of the combined entity, that is 150 of the total 250 shares issued.
Is 60%. Next.
The remaining 40% are owned by entity A's shareholders. Thus, the transaction is determined to be a reverse acquisition in which entity B is identified as the accounting acquirer while entity A is the legal acquirer.
You saw? Started. Is the legal acquirer. Then next.
Calculating the fair value of the consideration transferred.
They could have said, no, A is accounting acquiree. Right? Next.
If the business combination had taken the form of entity B issuing additional ordinary shares to entity A's shareholders in exchange for their ordinary shares in entity A, entity B would have had to issue 40 shares for the ratio of ownership interest in the combined entity to be the same.
That is, you have to issue 40 shares so that 60 plus 40 what? 100. What is 60 by 100? 60%, right? To maintain the same percentage control. Yes, sir. 40 shares.
Entity B's shareholders would then own 60 of the 100 issued shares of entity B.
Entity B only, not entity A, okay? Entity B.
60% of the combined entity.
Combined entity. Had B acquired A, then.
As a result, the fair value of the consideration effectively transferred by entity B and the group's interest in entity A is?
It is 40 shares into rupees. 40 per share, how much?
Fair value
1,600. But this 40 is only notional, right? Had you issued shares to me. Next.
The fair value of the consideration effectively transferred should be based on the most reliable measure.
He has given one more approach, most reliable measure.
Here, the quoted market price of entity A shares provide a more reliable basis for measuring the consideration effectively transferred than the estimated fair value of the shares in entity B. And the consideration is measured using the market price of entity A's 100 shares with a fair value per share of 16.
So here it's a coincidence, same, right? Same, no problem. So 100 shares into 16, how much? 1,600.
Measuring goodwill. Goodwill is measured as the excess of the fair value of consideration effectively transferred, that is the group's interest in entity A, over the net amount of entity A's recognized identifiable assets and liabilities as follows. Consideration effectively
Consideration is 1,600 as a net assets.
Current assets is 500. Net non-current assets revalued, fair valued is 1,500.
Exactly.
Current liabilities and 300 and non-current liabilities
You
400.
subtract. Net 1,000.
300.
So therefore there is a goodwill of
300.
rupees 300. Is that fine? Now guys, go ahead and complete step number 1, 2 and 3. Pause the recording, sir.
Unpaused
Yes? Okay.
on the screen.
So now we shall go through appendix B20, 21 and 22. Yes, sir, B20.
Measuring the consideration transfer.
Nothing but your step number 2, what you got. Remember 1,600. Yes, sir.
In a reverse acquisition, the accounting acquirer.
Who is that? B Limited.
Usually issues no consideration for the acquiree.
Yes or no? It is only A Limited issued 150 shares to you people, right?
Yeah.
You never issued any equity interest to my shareholders. That's the truth.
Instead, the accounting acquiree usually
Who is
issues
A Limited, accounting acquiree. issues.
its equity shares to the owners of the accounting acquirer.
Yes or no? 150 shares are given to you people.
Accordingly, the acquisition date fair value of the consideration transferred by the accounting acquirer for its interest in the accounting acquiree is based on the number of equity interests the legal subsidiary.
Who is the legal subsidiary? Nothing but
Entity B.
accounting acquirer.
Entity B.
B. See, again, it shifted the language. Legal subsidiary.
Would have had to issue to give the owners of the legal parent, which is entity A, the same percentage equity interest in the combined entity
Okay.
that results from the reverse acquisition.
So basically, I hold 40%, you guys will be holding what? 60%. Next.
The fair value of the number of equity interests calculated in that way can be used as the fair value of the consideration transferred in exchange for the.
So the 40
acquiree.
shares into rupees or 40 per share will be used as purchase consideration, 1,600.
So, but there he justified that if other information is available, that is more accurate.
No, that they haven't given. But generally what happens, IND AS 103 talks about what? Fair value of consideration, right?
Yeah, yeah.
That is why they said extra. Suppose you feel rupees 40 is not reliable, rupees 16 is more reliable, then use that information to find the purchase consideration. Understood?
Yes.
Next.
Preparation and presentation of consolidated financial statements.
How to go about a group financial statement going forward? Yes, sir.
Consolidated financial statements prepared following a reverse acquisition
Following a reverse acquisition,
are issued under the name of the legal parent.
very important. Legal.
Parent.
Who is the legal parent? A.
Entity
Is only A group
A. Yeah.
on top, not B. Yes, sir.
Which is the accounting acquiree,
Which is a accounting acquiree.
but described in the notes as a continuation of the financial statements of the legal subsidiary.
In the notes you write as if B acquired A and B is going to continue with the business, right? Next.
Which is accounting acquirer.
Next.
With one adjustment, which is to adjust retroactively the accounting
That
acquirers.
is retrospective. Retroactively.
The accounting acquirer's legal capital to reflect the legal capital of the accounting acquiree.
Is that fine? Next.
No, sir.
No, we'll come with them. No problem. Don't worry. Just read notes again. Read. Okay, I'll explain. Read.
Consolidated financial statements prepared following the reverse acquisition are
Okay.
issued under the name of the legal parent.
This part is okay.
Yeah.
Legal parent, which is A
Accounting
Limited.
acquiree.
A Limited.
Yeah.
Accounting acquiree. Next.
But described in the notes as a continuation of the financial statements of the legal subsidiary.
Okay, that is basically in the notes you have to say very clearly it is B Limited is going to continue the business. Okay, even though the name is A Limited. Next.
With one adjustment, which is to adjust retroactively
That is comparative information. Okay, retroactively.
the accounting acquirer's legal capacity,
The legal capital.
to reflect the legal capital of the accounting acquiree.
That means what? The number of shares to be shown in the balance sheet will be what? Not the 60 plus 40 notional.
250.
250 will be shown.
Because it
The
is
that's the truth, right?
yeah, entity A's balance sheet.
That is the truth. 100 plus 150.
Yeah.
Anyway, this point will be once again reiterated in B22. Okay, sir?
Yes, sir. That adjustment is required to reflect the capital of the legal parent.
Legal parent means A Limited, which is nothing but accounting acquiree.
Comparative information presented in those consolidated financial statements.
That's fine. Forget about that. Then go to B22. How to consolidate the balance sheet now on acquisition date? Yes, sir.
Because the consolidated financial statements represent the continuation of the financial statements of the legal subsidiary.
Of the legal subsidiary, nothing but B Limited.
Except for its capital structure, the consolidated financial statements reflect A. the assets and liabilities of the legal subsidiary.
Which is what? Which is B Limited.
Recognized and measured at their pre-combination
Pre-combination carrying amounts. Don't fair value.
The assets and liabilities of the legal parent
which is what? A Limited.
recognized and measured in accordance with this IND AS
Nothing but at fair value.
the retained earnings and other equity balances of the legal subsidiary
Which is B Limited
before the business combination.
will be shown as, because that is a legal, that's a accounting acquirer, right?
Yes, sir.
To take the retained earnings as it is.
The amount recognized as issued equity interests in the consolidated financial
The
statements.
amount to be recognized. Number of shares 250, no doubt. But what is the amount of share capital? Yes, sir.
Consolidated financial statements determined by adding the issued equity interest of the legal subsidiary.
Which is the 600 rupees, what is appearing in your balance sheet, plus
Outstanding immediately before the business
which
combination
is 600 rupees.
to the fair value of the legal parent.
What is the fair value of the consideration issued? 1,600.
600.
In all,
2,200.
will be the amount of share capital. Sir, of this, how much is premium? How much? See, anyway, you remember, that is why in the US, the securities premium is also known as what? An additional paid in capital. You know that? Is as good as capital. Suppose, Subhash, a company issues a 10 rupee share at a rupees 12. You know what is the entry they will pass in the US? Cash account, a bank account debit, how much? 12. To share capital, how much?
10.
Face value 10. To additional paid in capital. Nothing but what? Securities, premium. Or share, premium, how much? 2 rupees. Even the 2 rupees like what? Capital contributed by the shareholders. Only thing in excess of the nominal value. But tell me, can the company pay dividends out of this money, 2 rupee? No. What is the reason? If you do that, what? It's like returning the capital, yes or no?
Yeah.
It's a capital. See, therefore, it is nothing but even the premium, if any. You must say, sir, 60 shares are rupees 10 each. And this, these are shares issued at 40 rupees each. That doesn't matter. In all, 2,200 share capital. If you want, you can break this into what? Share capital and what? And additional paid in capital. APIC or securities premium. Is that clear?
Yes, sir.
Yes, sir.
However, the equity structure, that is the number and the type of equity interests in
See,
issue,
I said no, reiterated. The number and the type of shares
reflects the equity structure of the legal
or the
parent,
legal parent, the 250 shares.
including the equity interests the legal parent issued to effect
Issued
the
to
combination.
the owners of the legal subsidiary. Remember, I issued 150 shares. So 100 shares plus 150 shares issued. That's it.
Accordingly, the equity structure of the legal subsidiary is restated using the exchange ratio established in the acquisition agreement to reflect the number of shares of the legal parent
Same, 2.5, right?
issued in the reverse acquisition.
That's all. So don't read point T because no non-controlling interest. Now, having these points in mind, if you still have that intact, now let's go through the balance sheet. Yes, sir. The group balance sheet. For this, B22.
Consolidated balance sheet at 31st December 20x1.
Yes, sir.
So we have to write entity A's group.
That is A group.
A group.
A group.
Yes, sir. Non-current assets 3,000 plus 1,500.
It is 3,000 of B as it is, and plus the fair value of A Limited 1,500. In all, 4,500. Next.
Goodwill 300.
300.
Current assets 700 plus 500.
Okay, then
Total is 6,000 for assets.
then equity and liabilities under that.
600 plus 1,600 is
In
the
all, 2,200 share capital amount. What about the number of shares? 250 shares, very clearly stated. Have they stated that in the notes? Okay, next.
retained earnings is 1,400.
Only the acquirer accounting, that is B Limited, 1,400. Then
Total shareholders' equity is 3,600.
Next.
Non-current liabilities is
again add
1,500.
both. Current liability, add both.
900.
That's it. Notes have you given?
The
The 250 shares.
no sir.
Hmm.
The amount recognized as issued equity interests in the consolidated financial statements 2,200 is determined by adding the issued equity of the legal subsidiary
And
immediately before the business combination and the fair value of the consideration effectively transferred.
effectively transferred 1,600. And number of shares will be 250 shares.
I think they have given something. However, the equity structure appearing in the consolidated financial statements, that is the number and the type of the equity interest issued.
They written what is there in
Yeah, the
B22.
standard
Okay, right.
must reflect the equity structure of the legal.
That is all. Now, please go ahead and complete the balance sheet. Write a note. This particular balance sheet dedicated to para B 22 of IND AS 103. Pause.